Good day and welcome to the D-Marq-AnalyticS channel. Today, we're diving into one of the most powerful tools in the world of investing, Warren Buffett's investment checklist. This isn't a list of shortcuts or lucky guesses. It's the disciplined framework that helped build Berkshire Hathaway into a global powerhouse. And here's the twist. While the world is obsessed with AI, tech startups, and explosive growth stories, Buffett's checklist remains surprisingly, and sometimes controversially, relevant. By the end of this video, you'll understand exactly how Buffett evaluates companies, how you can apply the same principles, and whether this timeless approach still works in today's fast-moving tech boom. Let's get into it. Section 1. Why Buffett uses a checklist. Buffett's success isn't based on instinct or speculation. It's built on structure, discipline, and logic. A checklist protects investors from the biggest killers of wealth: overpaying for stocks, investing in businesses they don't understand, trusting the wrong management, getting swept up in hype, fear, or greed. In other words, a checklist keeps you rational when the market becomes emotional. And in today's world, where social media hype, meme stocks, and AI-driven narratives dominate, this discipline is more valuable than ever. 2. Is the business understandable? Staying within the circle of competence. Buffett's first question is simple. Do you truly understand the business? He calls this the circle of competence, the industries and companies you can evaluate with clarity and confidence. Buffett avoided tech for decades because he didn't fully understand how their competitive advantages would evolve. It wasn't until 2016 that he invested in Apple, only after he understood its ecosystem, brand power, and customer loyalty. Why this matters today? In the age of AI, cloud computing, and biotech, many companies are incredibly complex. Investors often buy into hot sectors without understanding the underlying economics. Buffett's advice? If you can't explain how a company makes money in one sentence, you probably shouldn't own it. This principle is timeless, and arguably even more important in today's tech boom. Section 3. Does it have a durable competitive advantage? Seeking economic moats. Buffett only invests in companies with strong, sustainable competitive advantages, what he calls economic moats. These moats come in many forms: brand power, Coca-Cola, Apple; cost advantages, Walmart, Geico; network effects, Visa, American Express; high switching costs, Microsoft. A company without a moat is vulnerable to competition, disruption, and margin pressure. How this applies to today's tech world. Tech is full of companies with massive moats, but also companies with illusory ones. For example, true network effects? Think Visa, Meta, Amazon. High switching costs? Think Microsoft Azure or Salesforce. Weak moats? Many AI startups with no barriers to entry. Buffett's moat framework helps investors separate real durability from temporary hype. Section 4. Is management trustworthy and competent? The importance of ethical leadership. Buffett believes that even the best business can be destroyed by poor leadership. He looks for integrity, competence, shareholder alignment, long-term thinking. He avoids companies where executives chase short-term stock price gains or rely on aggressive financial engineering. How to evaluate management today? You can assess leadership by reading annual letters, listening to earnings calls, reviewing compensation structures, observing capital allocation decisions. In the tech boom, this is critical. Many founders are visionaries, but not all are disciplined stewards of capital. Buffett's approach forces investors to look beyond charisma and focus on behavior, incentives, and track record. Section 5. Is the stock priced below intrinsic value? Ensuring a margin of safety. Buffett never buys a stock unless it's trading below its intrinsic value, the company's true worth based on future cash flows. He uses discounted cash flow analysis, return on equity trends, free cash flow consistency. This creates a margin of safety, a buffer against unexpected risks. Does this work in the tech boom? Here's where things get interesting. Many tech companies have negative cash flow, reinvent their business models every few years, trade at extremely high valuations. This makes traditional valuation harder, but not impossible. Buffett's principle still applies. If a stock is priced for perfection, the risk is enormous. Even in tech, buying with a margin of safety protects investors from bubbles, just as it protected Buffett during the dot-com crash. Section 6. Does it generate strong cash flow? Prioritizing stable earnings. Buffett loves companies with strong, predictable free cash flow. Why? Because cash flow allows companies to self-finance growth, pay dividends, buy back shares, survive recessions. See's Candies is his classic example. Small, simple, but consistently profitable. Cash flow in the tech era. Some tech giants, like Apple, Microsoft, and Alphabet, generate enormous free cash flow. These companies fit Buffett's criteria perfectly. But many high-growth tech firms burn cash to chase scale. Buffett's checklist helps investors distinguish between tech compounders, tech speculators. And that distinction can make or break a portfolio. Section 7. Building your own checklist. Discipline over emotion. A checklist eliminates emotional decision-making. It ensures you stick to quality, avoid hype, stay patient, focus on fundamentals. Buffett's success proves that structured thinking beats emotional reactions, especially in volatile markets. Tailoring the checklist. Your checklist should reflect your time horizon, your risk tolerance, your industry expertise. Buffett's framework is a foundation, but your personal strategy determines how you apply it. Conclusion. Buffett's investment checklist is more than a set of rules. It's a philosophy. By focusing on understandable businesses, durable moats, ethical management, fair valuations, strong cash flow, you can build a portfolio that compounds wealth through any market cycle, even in today's fast-paced tech environment. If you found this week's topic interesting or helpful in any way, kindly hit the like button. Share this video with someone who wants to invest smarter. Please feel free to subscribe if you'd like. We would like to thank you all for staying till the end, and we wish you all have a wonderful day ahead, and happy holidays to you and those whom you love.